Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, tax bros, welcome to your 2026 tax briefing. The new tax year is just around the corner, and that means a whole new set of numbers to work with. So in this explainer, we're going to cut right to the chase and break down the critical inflation adjustments and updates you need to know for your planning, starting right now.
So get this, the IRS has adjusted more than 60 different tax provisions for inflation. Now, we're not going to go through all of them, don't worry. We're going to zero in on the really big ones, the changes that are going to matter most for you and your clients when you're filing those 2026 returns in 2027.
Okay, here's our game plan. We'll kick things off with the big picture. What's driving all this? Then we'll dive into the core numbers for individuals, key credits, and what's new for businesses. After that, we'll hit on high income and estate planning and wrap up with a quick look at what's staying put. So, first things first, let's set the stage and look at the why behind all these updates. Because, it's not just your standard inflation adjustments this time around.
The main driver, outside of inflation, is this piece of legislation right here. Public Law 119-21, better known by its nickname, the One Big Beautiful Bill. And honestly, it's a real game changer. Why? Because it took a bunch of key provisions that were supposed to expire and made them permanent parts of the tax code.
All right, now for the numbers that are going to impact pretty much every single one of your individual clients. Let's talk about the new standard deduction amounts and the updated tax brackets for 2026. And you can see that nice little bump up from 2025. For 2026, the standard deduction for our married filing jointly folks is jumping to $32,200. For single filers, it's up to $16,100, and for heads of household, it's now $24,150. So, these are some solid increases giving folks a bit more tax relief.
And of course, it's not just the standard deduction. The income thresholds for all 7 tax brackets have also been nudged up for inflation. So for married couples filing jointly, you can see the brackets have all gotten a little wider. The top rate is still 37%, but now it doesn't kick in until taxable income is over $768,700.
Okay, moving on. Let's dig into some of the most common credits and deductions your clients will be dealing with. These are definitely numbers you're going to want to flag for your individual filers.
Yeah, we're seeing a whole range of adjustments here. The max earned income tax credit for a family with 3 or more kids is up to $8,231. The adoption credit gets a nice boost to $17,670. And for benefits, the health FSA contribution limit is now $3,400, and you can carry over up to $680. Even the monthly limit for commuter benefits is up to $340.
Now, let's switch gears and talk business. There are a couple of major updates on the business side that really open up some interesting planning opportunities for your clients.
And wow, this one is a biggie. That OBB legislation we mentioned, it dramatically increases the maximum employer-provided child care tax credit. It goes from $150,000 all the way up to $500,000. This is a huge enhancement. It's a fantastic talking point for your business owners when you discuss competitive benefits and employee retention.
The Section 179 expensing limits also get a pretty nice inflation adjustment. Businesses can now immediately expense up to $2,560,000 in qualifying property. The phase-out doesn't even start until total equipment purchases hit over $4 million. This is a key conversation to have with your business clients, especially when they're planning their capital expenditures for the year.
All right, let's turn our attention now to your high net worth clients. We've got some really crucial updates in the AMT and wealth transfer space that are going to be central to your advisory work this year.
Now this is a number you'll want to circle. For estate planning, the basic exclusion amount is jumping way up for decedents in 2026. It's rising to a flat $15 million. That is a massive increase over 2025, and it's a core number for any and all wealth transfer discussions.
The dreaded alternative minimum tax? Well, it gets an adjustment too. For 2026, the exemption amount for joint filers climbs to $140,200. And get this, the phase-out doesn't even begin until $1 million. This change means fewer taxpayers are going to find themselves getting hit by the AMT, which is always good news.
Now, with all these numbers going up, it is absolutely vital to also pay attention to what isn't changing. A perfect example is the annual gift exclusion. It's a cornerstone of so many wealth transfer strategies, and it is holding steady at $19,000 per recipient. No inflation adjustment for this one in 2026.
And yeah, that gift tax exclusion isn't the only thing staying put.
Which brings us perfectly to our final section because, let's face it, knowing what's static is just as important for strategic planning as knowing what's changing.
So thanks to that OBBB talked about, a couple of major items are now just locked in as part of our tax landscape. The personal exemption is still zero, and that overall limitation on itemized deductions, what some of us remember as the PISA's limitation, is still permanently gone. These aren't temporary things anymore. They are foundational rules we have to plan around.
So, what's the bottom line here? Well, from that huge jump in the estate tax exclusion to the souped-up business credits, the message is clear. It's time to start plugging these new numbers into your client conversations and your financial models. So the real question I'll leave you with is this: which of these changes is going to be the biggest pivot point for your client strategies in the year ahead?